Hi, this is Karen Lin. In this video, I'm going to discuss accelerating depreciation. We discussed in the previous video that if we assume an asset is used averagely the same across the useful life, we are going to depreciate every year during the 6 years with the same amount for the whole period. So every year we are depreciating 4,000 when we are calculating the depreciation. Remember, the formula for straight line depreciation is the cost minus the residual value. This is very important because only when you subtract the residual value, it would ensure at the end of the year, after you've done 6 years of depreciation, you are still left with the salvage value as desired. So we use cost minus residual value divided by useful life when we calculate straight line depreciation. In our previous case, that's 27,000 minus the 3,000, right? That gives us the 24,000, which is the amount that we possibly could depreciate, and divided that amount by 6 years, which means every year 4,000 is going to be used up. In this video, we will be discussing a different type of depreciation. In this type of depreciation, it is called accelerating depreciation, which means the firm puts more costs of the assets in the earlier years rather than the later years. Why would firms do that? One reason is to save taxes in the earlier years, right? If you have higher costs in the earlier years, you have lower income before tax, and then you pay less taxes compared to the straight line. If you remember in the previous chapter when we talked about the cash flow effect of LIFO and FIFO, it tells you that if you are using one method over the other, that could save you some taxes, which is the real cash that we pay to the IRS, and put those money in new investment. We get money return for those investments. So it's worth doing if we are having some cash flows saved in early years rather than the later years. The second reason is it's conservative to put more costs or to use up more assets on accounting on the book in earlier years. The third reason is that usually it's consistent with the physical usage of the assets. For example, if you have a machine, we assume in the early years when the machine is new, we use the machine more heavily, or the machine produce more outcomes for the firm. That is also an assumption. So using this assumption, the firm is going to depreciate more in the earlier years rather than the later years. So we only introduce one type of accelerating method, which is called double declining balance method. The key of double declining is that we are trying to use a depreciation rate that doubles the straight line depreciation rate. Okay, so when we are doing the double declining, we double the depreciation rate compared to the straight line depreciation expense. For example, straight line basically the rates would be 1/6, right? Because we are using 24,000 multiplied by 1/6. That is just 24,000 divided by 6 equals to 4,000 per year. But with double declining, I'm going to short form this as DDB, double declining balance. It will be 2/6. So we double the depreciation rate. The second point or second key is that we are no longer using the cost minus salvage value as we are doing in the straight line. So in the straight line, every year we use the same amount, which is the depreciable amount, multiplied by the rate, right, or divided by the useful life. But in a DDB, we no longer use the same number. Every year, we use the balance of the assets. I'll talk about it in more detail in a minute, but I just want you to notice the difference. It's called double declining balance. So every time we are calculating based on the remaining balance of the asset rather than the cost minus the salvage value. And at the end of the depreciation, it works just the same. The asset on the balance sheet should remain with the salvage value, which is 3,000. Okay, so I'm going to demonstrate how we can do that, because in a straight line case, we exclude the salvage value in the first. When we calculate the expenses, which makes sure the ending balance would be 3,000 because we already exclude the 3,000 here. But with DDB, we do not exclude the 3,000 at the beginning, but the asset will remain as 3,000 at the end. Now I'm going to show you how it works. I'm still going to use my original example where my PP&E cost 27,000, residual value would be 3,000. Okay, the formula is the following. First of all, we find out the depreciation rate, as I said, is double. It is a double of the straight line depreciation rate, which is 2 multiplied by 1 over useful life. As I said, that is 2/6 in our example. And the double declining balance depreciation expense would be equal to the depreciation rate, which is 2/6, multiplied by the assets remaining balance, or the assets declining balance. Now, the assets remaining balance or the declining balance would be equal to the assets cost minus the accumulated depreciation balance at the beginning of the period. Okay, it sounds very complicated, but it is really not very complicated. I'm going to show you how. So there are a couple steps that you could be used to guide your depreciation of DDB. Step 1 is to write down the depreciation rate, which is 1 over useful life multiplied by 2. That means I'm going to add a parenthesis here so that we don't get confused. So as I said, it would be 2/6. The second step, we need to write down the balance of the asset. Now, notice that I do not exclude the salvage value. Okay, so I'm going to use a depreciation schedule look like this. I'm going to write down the rate, which is 2/6, and then starting from the beginning balance of the asset, that is 27,000. You can see 27,000 is year 0, which means it is before we start to use the asset. So year 1, we start with the 27,000 here. We are calculating depreciation expense using 27,000 multiplied by 2/6. That is 9,000. That's our step 2. I have some 1, 2, 3, 4, 5, 6 here just to show you how I proceed with each step. So this sort of step is different from what I show in my PowerPoint. This is just showing you the sequence of the calculation. Okay, so step 3, we calculate the depreciation expense. As I said, that's the beginning balance of the assets multiplied by the rate. Now, don't use the ending, use the beginning balance of the asset, which means last year's balance. Okay, so for year 1, it is year 0's balance. We are using 27,000 multiplied by the rate, that's 9,000. So what does that mean? That means the first year, our firm should be debiting depreciation expense 9,000, crediting accumulated depreciation 9,000. Step 4, calculate the new balance, which equals to the old balance minus depreciation expense. So this is the sequence. We calculate the depreciation expense, and then I'm moving to sequence 2, using the original balance, last year's balance, minus this year's usage, right? Expense, the depreciation expense has the economic meaning, which is the usage of the machine or the equipment. So we are using up the equipment for $9,000. that would be subtracted from the original cost. So the ending balance of this machine would be 18,000. Okay, so that is the ending balance. What does that mean? Economically, that means that's the dollar amount that could be used in the future 5 years. Okay, the rest 5 years, because this is the first year. All right, so we calculate the new balance. And then we start over from step 3. We calculate the expenses again until the last year. So I'm going to move to sequence 3. I'm using year 2. I'm calculating using last year's ending balance or this year's beginning balance. That's 18,000 multiplied by the rate. That is my expense. Again, I'm debiting depreciation expense 6,000, crediting accumulated depreciation 6,000 for the second year. Okay, that gives us the ending balance, sequence 4, 12,000 for this asset. We move to the next cycle. We use the 12,000 to multiply by the rate, give us the expense, and it tells us the ending balance, so on and so forth. So you're just repeating my sequence 1, 2, 3, 4, 5, 6 until step 9 or sequence 9. Okay, the last year. Last year is a little bit tricky. A lot of my students would be using 3,555 multiplied by 2 over 6. If you do that, that would result in a different and incorrect balance of the machine. So now remember, we said that at the end of the day, we want the machine to end up with 3,000 residual value or scrap value, because we know at the beginning of the purchase of the asset, we estimate the scrap value to be, or the salvage value to be 3,000, right? So we want that balance to end with as 3,000, but our previous year's balance 3,555. What is the difference between the two would be the usage of the asset, which means you only have $555 dollars of the asset that to be used in your last year, no matter how you are using the asset, because this is a fixed result. This is fixed at the end of the 6th year. Okay, so you can only take the difference between the two. That economically, that means those are only the amount. The difference is the only amount that a firm could use the asset for. Okay, so that's 555. All in total, we end up with 24,000, which tells us that using straight line and using DDB, we are depreciating the same amount in total, which is 24,000. We don't have any advantage using one method over the other in terms of total expenses, but we do have a different distribution of using different methods. So if you look at the T account, you will see that the equipment would always be shown as 27,000. Accumulated depreciation will be from 9,000 to 6,000 and to 555 for the 6 years. It's a double declining, so you can see it's declining over the years. We are using more of the asset in the earlier years, using less of the asset in the last year. So that's in total 24,000. Depreciation expense would be corresponding to the accumulated depreciation, because we debit depreciation expense, we credit accumulated depreciation. So every year we would debit the same amount as we credit the accumulated depreciation. The only difference is that all those expenses accounts closed at the end of the accounting cycle. Okay. I left in this video one practice exercise for you to try. So you can pause this video and look at this practice exercise and try. What is the double declining balance of this asset? And here is the solution. And notice that at the end of the 8th year, you need your asset to be ended up with the salvage value. That means the last year's amount is the difference between the previous year's balance minus the salvage value, whatever that is. It could be a little bit higher than year 7, but that's fine. All right, the last topic is to compare these two different methods. So if you have studied the previous chapter talking about the difference between FIFO and LIFO, you would understand what I'm talking about here. So we are comparing straight line and double declining because each year the straight line and the double declining are using different depreciation expense, so it creates a difference in income before tax and then tax expenses. Okay, so you can see if we use straight line depreciation, everything else equal, the depreciation expense will be 4,000 and the income tax will be 6,300, which means that's the cash we are going to pay IRS. For double declining, the expense will be 9,000, everything else equal. The tax expenses will be 4,550. The difference between the two are the savings in cash. Okay, let's say if we could reinvest those difference in a 12% annual return project, you will see that the difference in the income taxes can be $1,750 can be reinvested in a project that with annual return of 12%. That's 210. And of course, the 210 you earn has to pay income taxes again. So it is only 65% will be left with you. That's 136.5. That would be the benefit from investing the difference in the taxes to a project which could generate some return for us. I'm going to explain the reason why in the first part of the video, I raised the question. I said, why do we not consider a pen or a calculator as PP&E, although they have more than 1 year of useful life? Now you can see the reason. For a pen, for example, a pen is worth what? $2, right? Are you going to calculate their salvage value? Are you going to estimate their useful life? Are you going to depreciate them, use different methods? It doesn't sound reasonable because there are so many pens that you are using. It's large in the numbers that we are using. It is small in the amount it occupies. So in accounting, there is an important principle that it's called the materiality principle, which means you want to put your efforts into the most important things, right? So you don't want to spend too much time on a pen, which doesn't really make sense to depreciate all pens. So that is why we do not consider supplies or utilities with very small amount of value as PP&E. So PP&E are assets that last for more than 1 year, and it is material for the firm. Okay, so I want to conclude this video at the end with a summary that a firm, when purchase an asset, would have to be considering the useful life of an asset, the cost of an asset, the salvage value of the asset, and the useful life of the asset. Now, I also want to emphasize the economic meaning of all the accounting issues we just talked about. When we first purchased the asset, economically, the value of this asset is $27,000. That's the original value of the asset that could be used up for the firm. Because at the end of the day, we know that we are going to recover $3,000 from this $27,000, right? That is the recoverable value when we dispose or we send the asset to the scrapyard. So in between, there is only so much money that we could, or so much value that the asset that we could use up, which is the difference between the cost and the salvage value. That's the difference between the two would be 24,000. And we estimate how many years that we are going to use the asset. That is the useful life. For depreciation expense, it means for all the depreciation expense that we are recording, for example, here, it means how much we are using up the asset per year over the useful life. In this straight line case, we assume the asset is used evenly throughout the 6 years. However, if we are using the double declining method like this, we are assuming the firm is using up more of the asset in the earlier years than the later years. That's why we debit more in depreciation expense in earlier years than the later years. When we consider the expenses, it is a usage of that asset. So we use more of the asset in the earlier years. Okay, so I want you to remember the formulas absolutely. I also want you to remember there is an economic meaning after or underlying our accounting decisions. All right, I'm going to stop my video here. If you have any questions, you're welcome to email me or leave a comment under the video.